It definitely has been a very interesting market in 2025, and I have to say, welcome back.
Thank you. Thank you very much.
When we look at inventory in the Kitchener-Waterloo market, what it tends to show on the real estate board is that we're in more of a balanced market,
Okay.
meaning that there is pretty much the same amount of supply as what is selling right now in the market. And I think that is different depending on the type of actual home product that you're actually moving. So from a townhome to a detached home, you're going to see that fluctuate. We're going to see more demand, which has typically been more in that detached home price range, right? So I would say that in that essence, we're seeing balance, but to some extent, we're seeing it more of a buyer's market.
Okay.
Right now we've got slightly over 2,000 units right now overall. That's encompassing condos, semis, townhomes, detached homes up for sale right now, and that's pretty much the same as where we were 30 days ago.
Okay. All
Okay,
right.
which is pretty interesting. I actually thought we would see more of an increase
Right.
of properties going up for sale for a multitude of reasons, which I'll go over. But when we look at it from this time last year, we're actually up about 15% in more listings.
Okay.
And a lot of that has to do with a couple of metrics. One of them being that interest rates are still higher than where we thought they would be. There's a lot of mortgage renewals that are coming up in 2025, and I say people sometimes have to sell, not want to sell.
Yeah.
We're also in an age demographic in Canada where we're almost entering about 30% of people that are 55 and older. And so we're seeing people, what I call not downsizing, but right sizing.
Oh, I like that term.
Right.
Okay.
So people are looking to sell, maybe look at a different location in Canada that's more cost effective for them as their incomes decrease and their early retirement or going into retirement, or maybe just to have better cost of living every day because it's so expensive, and especially in our region. So there's multitude of reasons why I think that we're seeing more listings. We're also seeing distressed buyers, so people that were homeowners and are defaulting on their mortgage. That has gone up a lot in Canada. And again, going back to where they don't want to sell but have to sell because of circumstance. But overall, I would say that, a buyer has more opportunity in this market because of more supply out there. So we're seeing the conditions of financing, we're seeing conditions of home inspection. We're also seeing that the average price point has come down just slightly, about 1% from 12 months ago. So we're not seeing this huge bevy of over and above listed price. What people are pricing today as real estate agents are pretty much either accurate to what the market is dictating in today's environment, or they're going well under the ask price to try to drive that market where it's conditional of offers, from 2 or 5 days from the time that it's listed. And it's working in some areas to be able to do that. So even if it's listed low and it sells 100,000 above asking, that doesn't mean that the home is above $100,000 asking. It just means that they're pricing low to cause more people to be able to come and take a look at the property, right? And then that the interest in that, they're able to get a buyer out of that. And it does work in some areas, and it does work in some type of market. But I do think that relatively, and we're seeing it a lot, more people are coming into the market space now than we traditionally have as first-time home buyers. They've either been sitting on the sidelines because waiting for interest rates to come down. We have seen decreases this year. That's helped people qualify. They've worked out ways to be able to either, one, save more money for a down payment, come up with a co-signer if they're first-time home buyers, and be able to get affordable housing in price points where we haven't seen it traditionally. The condo market, we're seeing price points, 350,000 to that 500,000, where we normally weren't seeing that. We were seeing condos, 600,000 and up. So that starter home is more of a reality for people. And even townhomes, if we look at townhomes, you're seeing values come down in townhomes because there's a lot of supply in the marketplace. So it's bringing down that price point to maybe 650, 700. And more first-time home buyers can afford that and maybe potentially get a mortgage helper in there to offset that mortgage payment.
And I know we're sort of in the dog days of summer. We're at the end of July, but we've talked about this in the past, and you bring up that idea of the condo market. With Conestoga, Laurier, Guelph, Waterloo, we've got these big populations of students. In your experience, do you see parents coming in and maybe purchasing a condo for their student or turning it into something that that they're going to use as a rental property down the road? Is that the time that we might be heading into as we get into August?
Well, I think to your point, it's been something that's been in our marketplace for a while, and people were doing that. Do I see a lot of it? Not necessarily right now. I think cash is king, and people are still kind of sacred to that, knowing what's going across the border, uncertainty about tariffs and inflation. But having said that, I think that that price point of affordability in a condo is there. So if you have a child that's going to university here in the Tri-Cities, it's a great price point to be able to afford that and then turn it into a rental after your child's done university, or bring in another student there to help offset the mortgage payment. Can't go wrong with a condo unit at $350,000. However, be careful of condo fees, and that's where I'm seeing a lot of people getting some hiccups right now when they're purchasing investments or even going to sell these condos. It's where condo fees have gone, because we're seeing some condo corporations where those condo fees have gone from like $400 to $800. They've doubled, and you've got to do your homework on the condominium complex, the condo corporation, what's in the condo reserve fund. So that's funds that are there to be able to help with any type of repairs or upgrades that need to be done to the condo. Your lawyer, your realtor will be able to help you through that so that you're making the right decisions and not getting into, it could be a lower price condo, but there's not enough in the condo reserve. There's repairs. It's an older condominium complex where you might be seeing condo fees go up quite a bit. And then your future saleability or value might decrease because of that. And that I've seen quite often. So people have to be really cautious when they're buying condos. Having, the right, I always say that partnership between the mortgage, the real estate agent, your lawyer will help you navigate and get the right option for you when you're looking at investments or buying for your child.
If you're looking at getting into the market, or this is your chance to jump in there. You mentioned this off the top. Where are we at right now when it comes to fixed and variable? Has it changed much since the last time you and I sat down and talked?
It really hasn't moved the needle a lot. You haven't really missed a ton.
That's okay.
We've got an important announcement that's coming up on the 30th of July, which is the Bank of Canada announcement. That will be, after that, we'll have another 3, and then we're at the end of the year. So having said that, we haven't seen any type of decreases this year at all. No increases, which is good news. But we haven't had any type of decreases in bank prime since last year. Right. And, we're all in anticipation with every announcement that we're going to see it. Most market economists have said it, that we're supposed to be seeing. We were originally at the beginning of this year, we're supposed to see a 1% decrease. We were supposed to now see a potential 0.5 point by the end of the year. I think tariffs and, the stickiness of inflation as a result of that is making the Bank of Canada more what they call hawkish and reserve in terms of making those decisions of decreasing bank prime. And I do think when they do need to decrease it, they'll be like pushed to the wall to make that decision because it's what has to be done. Do I feel it should be down? 100%. But I mean, I'm not running the Bank of Canada. So, and a lot of us feel like, we should be in that position to do that. But we probably won't see a decrease on the 30th. And the next announcement's actually in September. So we get a month holiday in August when people are taking their summer vacation. So does the Bank of Canada. And then we circle back in September, and then there's that on the table. Most market economists now are forecasting no change in September. We might see it in October and December. I think now I've changed myself in terms of, being optimistic on that 50 basis point reduction. I think we'll see 0.25%. But next year's a new year, and I think with inflation, it's always a lagging indicator, and I think there's a lot of things economically that we are struggling in Canada. I think tariffs are not helping in that situation. So bad news is actually good news on rates, and bank prime we should see come down, I think, probably a full point, perhaps in 2026, but that needle will move much more next year than this year. So it's a great question because we're actually seeing a lot of people this year early renew. And for a few reasons. I think there's a correction next year with a lot of mortgages that are coming up for renewal. And what I mean by that is there's 60% of Canadians that are coming up for renewal this year and next year. The biggest amount is going to be next year, but that's where we're going to see the biggest correction on values. So between May of 2026 to October of 2026, those mortgage renewals in that 6-month period, given where housing market was 5 years before that in 2021, that was the peak of where we saw values go up.
Right.
So they were still high in May of 2021, and then they went exponentially about $100,000 higher on average in that 6 months. Those mortgages are coming up for renewal. So if we're looking at them coming up for renewal, given in today's market correction on values, because we saw about a 20 to 25% correction on values coming down. Specifically, I'm talking about in the Ontario market. I'll talk about, where we are in Canada, but if we look at specifically in Ontario, with that correction and those properties and those mortgages coming up for renewal next year, that means the equity is not there that the people would have originally traditionally had over 5 years.
Right.
So their mortgage amount, if they're looking to, at time of renewal, what do people do? They look at what they've got outstanding in debt. Most people in Canada are averaging about $70,000 and up in terms of consumer debt per family. And most of them have interest rates on unsecured debt in the double digits, right? From Visa cards to lines of credit. So if we look at that time of renewal as a time to consolidate and get people into what I call financial wellness. And so we consolidate it into their mortgage, wrap up their payments into one payment, help bring up their credit score and help them cash flow. They're not going to have that option as much because, or if at all, because in that 6-month period next year, there's not going to be the equity to go to 80% perhaps. Of what the new value would be. So I'm not saying that the values are going to go down next year per se, but they certainly haven't gone up over the last few years. We've had that decrease in values, which means the equity is not there to do debt consolidation or perhaps even transfer your mortgage to another lender because you're over leveraged to one, specifically if you bought 5 years ago with 5% down. Okay, you're not in great shape that way to make choices on your mortgage renewal. So what does that mean for you? So let's say you are a buyer that you bought 5 years ago and you had 5% down and your value hasn't moved the needle in 5 years. It doesn't mean you can't renew with your existing lender. And perhaps there might be the option to transfer it to another lender. There's still a lot of that gray that these banks and I think the federal government are working out because there's going to be a lot of people in this situation. But what's going to happen is the competitiveness of interest rates and what we traditionally seen in Canada will not be there next year. And so what I'm telling people this year is if the equity is there in your home, okay, now, because of some correction that's going to be happening in 2026, let's look at ways to maybe mitigate it now. And there is mortgages out there, there's products out there such as a cashback mortgage where we can pay out your penalty without adding that balance onto your mortgage and restructuring your mortgage to get you into a lower rate to help you cash flow better on a monthly basis. And I can't tell you, I've done webinars on this. I've had an influx of business with people wanting to take a look at these strategies because right now it's about maximizing what you have because tomorrow is unknown and next year is unknown. We can say the market's going to recover, but to what extent, I don't know because we don't know what's happening across the border. Right? So it's really the elephant in the room right now is on renewals. It's just helping people on a case by case. No one's financing. My financing is not the same as yours as the next person, not as your bank account. And that's why having conversation with people is helpful, but it's not going to make your absolute decision. You need to sit down with a mortgage professional, your financial advisor. Let's work out some solutions, make sure they understand what the market's doing right now, what's happening across the border so that you can navigate and win on your next renewal and not get stuck in this vortex of negativity and where the market is because there is opportunity right now. We just have to take a look at it in a different lens.
And you bring up that good point. It doesn't hurt at all to start to look and start to ask some questions and say, okay, well, what if this and what if that? And we've said this before that, you don't want to be leading it until 6 months before it's time to renew your mortgage. You really should be looking at it 2 years, a year and a half out to at least say, if you were to do it right now, here's what you're looking at. And giving someone a chance to at least have an understanding of what's going on. Because I think a lot of times, for a lot of people, that might be sort of that set it and forget it. I've got my mortgage, it comes out every 2 weeks, I'll deal with it again in 5 years. But that the way the
You can't
market
do
is
it.
right now, we can't do that.
And I think one of the things is that the federal government's changing some policies next year on qualification.
Okay.
So what that means is that from the banks and financial institutions, they're telling, because they know how many mortgages are coming up for renewal, they're saying that they're going to cap how many mortgages they can have for per homeowner, of how much outstanding debt they have.
okay.
So, and the metric is 450%. They will only allow a certain portfolio of the bank's business to have clients with up to a 450% cap of outstanding debt. And people can say, well, that's crazy. Like, who's got that? Well, that's actually pretty much where we're seeing people
lot of
at
people
right
are-
now.
yeah, they're there.
So, what does that mean for you? It means that you could qualify. You've got your credit still is good, but you're over leveraged in your debt. You're coming up for renewal, and the bank, and you're coming up, let's say mid-year. The bank could have already been capped at that 450% of how many they're allotted to have, and you will get declined and not know the reason why. Can you go elsewhere? Yes, there is options 100%. Can you still get best rates? Yes. But the thing is that that's coming down the pipe. And what people have to know is there's a lot of rules that are going to be changing that's going to make it tighter and harder for people to qualify. So getting ahead of the game and looking at ways to do it now will get you on a better path into the next year.
And we've talked about this as well too in the past. You don't necessarily owe any financial institution your lifelong loyalty, right? Well, we said, our parents were like, well, I always dealt with this bank, or I always dealt with this. That they're not necessarily looking at your best interest. So take the time to go out and look and say, okay, who can I be working with? And now's the time to start to do your homework.
Well, and I always have told people, don't have all your eggs in one basket. People think they get ahead better because they have everything with one institution. That's not necessarily right. No. Keeping your mortgage separate from where your investments and your banking is will help you leverage when you go into that bank, because they don't have your mortgage, and that is where they make a lot of money, is having their mortgage placed with you. Right. So it's important to kind of separate what you do, just like investments, right? Investments, people diversify. They'll use a financial planner for some stuff, and then they'll go through Questrade or Wealthsimpli to be able to diversify their portfolio and look at, GICs or TFSAs or dividends or stocks, right? So everybody has, usually on the investment side, an array of different investment sectors and ways they can do it. You got to look at that on your mortgage too, right? Take the time. Don't be crunched to the last minute to look at options because you're unsure and scared of what will happen, because what will happen is you'll miss out on an opportunity. And you can save, statistically, with every renewal, you should be saving from bringing down your balance and the overall product about 13 to 15% overall in terms of being able to effectively pay off your mortgage. But that's making sure you've got the right product and strategies. And that's why dealing with a mortgage professional will really help you, educate you on that side.
When someone comes to see you, what sort of homework do you want them to have done before they walk in the door? Because we've talked a bit about this in the past. If they're looking to make these decisions, if they wait too long, their decision's going to be based around fear in a lot of ways. You want to see them ahead of time, but they've got to be doing their legwork as well too.
So the most important thing for me to have when people come in to see us is their documentation, because that will help give us a clear picture of where they're currently at with their finances, with their mortgage. Having their current mortgage statement, even their annual statement, will be able to work out some numbers to where they are effectively today with their balance. Knowing where their income is. A lot of people in Canada still are unsure of how they receive income. I know it sounds a bit odd, but most people in Canada have 2 to 3 jobs now, and they're receiving income through either an online platform, or they're not considered full-time permanent. Those are not the days that we used to have. The good old days are gone. And they could be full-time contract. They could be self-employed. They could be commissioned. And they're just putting money into their account to survive and not thrive. And so we have to break that down so we can position people in a product that's going to be able to work for them effectively. And in today's environment in Canada, what's available, and also hopefully be able to get them with where there are multitudes of income coming into not only best rates, but a best mortgage product. So having your documentation is so important. So that's why we vet with our clients first a list of what we need. And so it may be extensive what we need, but it will give us a clear picture that I know where we need to go going forward. Perfect. And it helps educate people maybe where they need to move their money because they haven't been actually putting it into their bank accounts properly. Yeah. We do a lot of financial coaching. So helping people really, okay, what do you look at when you get your paycheck? Do we talk about putting it into savings, your deposits first, which is your savings first before you go pay off any bills? And then let's talk about where your income is versus where you are with your mortgage payments. Because nowadays, like, we are not indexed to inflation at all in Canada the last decade. People's incomes have only gone up 16%, but in the last decade, housing prices have gone up 120%. Like, and so no wonder people are struggling.
Yeah.
And, this financial literacy piece goes out the window in Canada
Right.
because people are just saying, well, I've got money in my account. I need to pay my bills. I got to keep a roof over my head.
Yeah.
And that becomes the first day to 365 days. And then, we go on. And I've seen it and I feel bad for people. So how do we look at it? Maybe sometimes too much of a house is too much of a house right now.
Yeah.
And I always say to people, it's not the house that makes you, it's the people in it.
Oh,
Right?
I like that.
And it's so true though, right? So if you look at it, like, I'm in the housing business, but I also know if it's too much, it's too much. And financial wellness and mental wellness is a priority for me. So maybe downsizing and right sizing is what we need to do in this environment. Give you some money in your pocket because the equity is there. Pay off your bills so that you've got your credit score really good. And start breathing again and enjoying life because we all know it goes by too fast. First-time homebuyers right now are in a very different environment. Interest rates are still higher than what we traditionally seen. A lot of first-time homebuyers have multiple jobs, so working through in terms of how to be able to utilize their income for qualifications. And here's one of the biggest challenges I see we've had, which is great. We still have so many first-time homebuyers that are excited to buy a house in Canada, which I still think is a positive thing and why I got in the industry for the dream of homeownership and people to have the right to own a home.
Yeah.
So in saying that, what the challenge is that because interest rates are still in a higher environment, we have to qualify people using the stress test, which is 2% higher. So if the interest rate is 3.99% on a 5-year fixed rate, we have to qualify them at 5.99%. That doesn't mean that's what they're paying on their mortgage payment. It means they have to qualify. And the whole premise behind the stress test that the government implemented years ago was to help people withstand higher interest rate environments in the future.
Right.
And I understand that. But having said that, everything has increased in Canada.
Yeah.
So it's hard for people to be able to afford a property right now, given that values, we've seen some correction in values, but we're still, remember I said that stat, 120% over last decade, values have gone up in Canada. So how do people move the needle? And so a person that's making $90,000 right now, which is a great income for a first-time home buyer that's probably just starting out in their employment over the last 2 years and have saved money down, maybe not 20%, maybe that 10% down, you can't even qualify for a house of like 500,000 right now, 5.25, because there's a qualification metric that we have to use. Where if we didn't have the stress test, and given that rates are really, they're higher than where they were, but they're still on average very good right now. A 5-year fixed at 3.99%, that's pretty much where we were in 2019.
Right.
But having the stress test is limiting people. So what's happening is that we're having to have co-signers. So parents go on as a co-signer to be able to help people qualify, or they get gifted money for down payment, 20%, so they eliminate CMHC premiums, insurance premiums. But what happens is that we still have to sit down and talk to a home buyer saying, okay, if we're putting your parent on so that you can qualify, let's say for a townhome of $600,000, we still want to look at that mortgage payment on a monthly basis to make sure that the individual's income can still manage making that monthly payment, as well as property taxes. Let's say there's a condo fee or a small home maintenance fee, insurance, phone bills, right? Water, you name it. Everything that is encompassed in terms of not just a mortgage payment and property taxes. Maybe they got a car payment, right? And then groceries. Let's look at everything and put it into the micro on a budget, because what I don't want to see first-time home buyers do is be completely cash poor day one they get that key. And so that's where I'm seeing the struggle with people, is that we might get the parent to come on, but realistically, we have to look at how do we restructure that property, maybe get in a renter to come into the basement, maybe we have a secondary suite. that's they buy a property that's a duplex, that's legalized, so that they can be able to have some extra rent coming in. Maybe they get the property with a friend so that they can split the payment, or a family member comes in to be able to help with that. So we look at different ways. So having a conversation with a first-time home buyer, I mean, I've been doing this for 3 decades now, has totally different to where we were before, right? And then going to 5 years from now,
Right.
okay, what are we potentially going to be looking at? Not only an interest rate, but with your career, where do you think you're going to be in 5 years from now? You're going to have to make a move, or you're going to have to still stay in Canada. I mean, remember, people are making money all over the world now.
Right. Do you find first-time homebuyers tend to be realistic when they come to see you, or is it sort of pie in the sky and you've got to say, whoa, 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 like take all these other things into consideration? Where are their heads at when you're talking with them?
Actually, it's a great question, because I've seen a big shift. I think first-time home buyers are more realistic now. I think they watch a lot of TikTok.
Yeah.
And there's a lot of education on there, whether good or bad, but there's still education on there. And there's a lot of people that have gone through this, and they've seen that it's not so easy anymore. And the reality of where it's at. So I'm finding more people are realistic. However, they're still optimistic they can qualify on their own. And I'm not saying people can't. Like, there is certain circumstances, depending on income and down payment, they can.
Yeah.
But more or not that I see, we have to have that parent go on as a co-signer. And then having the conversation with the parent is how to take them off, right?
Right, because that's the thing. It's great to have your family to back you once you're getting out the front door. You're getting your own set of keys. But at some point, you want to cut those apron strings, and I'm sure the parents do as well too. And I would think that the first-time homebuyers, they're like, yeah, it's time for us to prove that we can do this. But you got to be smart about all those steps along the way.
So if you're having a co-signer, and I just had the conversation this morning with a couple with their son, is okay, what is your plans in the next 5 years? Because if you're looking to right size and retire, we have to look at, okay, can you qualify for what you want to do in 3 years from now?
Yeah.
And if they can, great. If they can't, then I have to look at, okay, how do we look at moving the needle to potentially getting them off their mortgage of their son within the 3 years? And what type of income does he have realistically to be able to move the needle on that? Yeah. So again, we might be in the situation where during these 3 years, his income either has to adjust exponentially, or he has to look at getting a mortgage helper in, maybe doing some construction on the property to add in a second suite for rental income, so that we can look at qualifying it and removing his parents. So it's not just a one and done anymore. In terms of qualifying, like, there's different branches and arms of a mortgage financing path now and homeownership path that you have to look at to protect everyone involved, because too many people I've seen that were co-signers, and then they've come to me after the fact not using us, and no one's done the homework properly from the expert's position, and protecting everyone. It's not just about the first-time home buyer, it's about the parents.
Well, and the other thing is too, like, there's so much stress on a family from a financial standpoint, and if you add into it the fact that the money's coming from the parent, that doesn't always work out well, right? And you're dealing with a lot of other issues that will come from that. You made that point about that. The quote about seeing people excited to buy a home, right? And I think you and I are from the generation where it was just assumed that this would happen. You go off, you go to school, you get the white picket fence, you do this, you have your kids, But there's, as you said, there's this shift to realization for a lot of younger people, and I think there may be that sense for some of them that I'm just going to keep renting because this is the way that I can see myself sort of moving through. But what you're saying is, there are ways around that. We can make it work.
Yeah, and I think to your point, like, when we first bought our house, my husband and I was 25. And it wasn't even a question that we were going to buy. No. It was an expectation, but it was something that it's every day. You go get groceries. Okay, the next thing you know, we got to go buy a house. Yeah. What does that look like? And it was something that you looked forward to, but didn't think you would be challenged on. No. I mean, housing was a lot more cheaper then, but everything was, right? Yeah. But putting it in perspective to today, that's not where, if you talk to a lot of young people, I'm hopeful because I have a lot of people coming in that want to buy, that are in their late 20s, early 30s. You got to remember now, the average first-time home buyer age now is 36. When I first started, it was 24.
Wow.
So it's a
Wow.
big difference, but I'm excited and optimistic that I still see people wanting to move the needle in home ownership. However, there's a large amount of young people, and I don't just talk to young people that are in the housing buying market. I talk to young people that are not even looking or considering that right now. But even still, it's not even something, no, in Canada, are you kidding me? I'll never be able to afford it.
Right.
And I'm also going to look for employment outside of Canada, or, look at it like renting and diversifying income by investments is a way that they're going to go. And I'm not saying that's a bad thing. Like, I've always said this, I'm in the mortgage business, but I also think sometimes there's times in life where owning a house maybe not be for everyone. And investing your money into different caveats to move the needle on compound interest so that you have retirement savings in a different way is not a bad thing. And maybe you circle back to real estate down the road. But it's the fact that I'm seeing more young people that way than I'm seeing the conversation of, oh, well, in 10 years, you know what, I'll buy a house. I'm not seeing that anymore.
Number one, the question we always get, should I get a fixed mortgage or should I get a variable rate mortgage? What do you say?
Number one question we get asked this year.
All
That's
the
true.
time.
All the time. Doesn't matter what market it is. Long-winded, but I'll try to make it as short as possible.
problem.
Is there's no right or wrong answer to this. It
Aha.
depends on your financial situation.
Okay, good to know. And that's why you're going to book some time to go in and talk with Tracy and take a look at it, because everyone's situation is different. She mentioned that about when it comes to finances, when it comes to what's in your bank account. If all you're doing is looking over the fence and wondering what your neighbors are going to do, guess what? They're looking over the fence and looking at you as well too, and you can't spend all your time comparing yourself. All right. Number two, I'm a young person, I'm in my 30s. This is what we just learned about. Do I get into the real estate market right now, or do I wait on the sidelines for a little bit and see what happens next?
So great question. And again, looking at your financial situation, look at your income.
Okay.
What is your income? Is your means of income over the next 5-10 years? What is your goals? And are you still staying in Canada? What's your family dynamic? What is going to be in terms of your structure of, are you going to stay as an individual or as a family? And that will help determine a lot of factors. The number one thing is really sitting down and doing that mortgage application so that we can really see and have that strong conversation of what are the strategies you want to do over the next few years, so that we can make that decision on if this is the right time to buy or not for you.
Number three, if we see bank prime go down, will fixed rates follow? Do they go down?
So what a great question. I think this is the second one that I get that's the most common. They're two totally different metrics. Bank prime is based on what's happening here with inflation, unemployment, where we are at with the consumer price index. There's a multitude of metrics that are used to determine inflation, which affects our bank prime rate, and how the Minister of Finance moves the needle on increasing, decreasing, or keeping it the same. This has nothing to do with what happens with fixed rates. Fixed rates are totally based on south of the border with the U.S., how their economy is doing, what's going on with their market. Their 10-year treasury affects our 5-year bond yields, and our 5-year bond yields affect when banks have the pressure to increase or decrease rates. So I always use an analogy: if the U.S. is sneezing, we get pneumonia in a bad or good way, depending on what's going on.
All right, I'm going to throw another question at you here.
Yep.
It's a personal one. Here we go. I'm retiring. I still have a mortgage. Do I need to come and talk to you about that, or just let things go?
Wow, that's actually a great one. There's a lot of people in that situation right now.
Yeah.
You have to come and talk to a mortgage professional.
Yeah.
Really, what is your goals for retirement?
Right.
What is the expectation of what you want to do? And this is a time where you have one shot to maximize, right?
Yeah.
Your savings and what you've built and what you've paid off. And let's really make some concrete, sound choices financially for you, because the current economic and the housing market always shifts. Yeah. So it's timing of if you are looking to right size, when to do that, or is it something where maybe potentially your children take over that property? Like, there's so many different ways to be able to move the needle for you, but you have to speak to not only just a mortgage professional, a financial planner, really look at some solutions, and sit down and think about what you want, because to set it up right will help you have a better retirement in the future.
And I think we've talked about this before as well too. The old mindset was when you retired, the mortgage is already paid off. But we know that's not the case. People live their lives, and they live their lives by borrowing against the mortgage, or they put in they've done renovations in the home. So they're sitting here, they're retiring, their income is going to be going down, but that mortgage is still sitting there. So you do need to take the time, go and talk to Tracy ahead of time, and figure out all of these things to say, okay, as she said, what's your goal for retirement? Is it just to sit in a rocking chair and shake your fist at the clouds? Probably not. You want to be able to travel, or you want to be able to help in the community and help your family out as well too. You really have to be paying attention to those things.
Well, the thing is too, if you look at it for over 30% of the population in Canada is 55 years and older. Mm-hmm. So in the next decade, we're going to see that increase. They were saying probably another 10 to 12%. Wow. That's significant. Yeah. And when we look at the savings that people have, as a family or just two individuals in that age group, it's less than half of what they need to retire. So being strategic on, most people's wealth is within their actual real estate. Yeah. So how do you move the needle on that to keep things sustainable for you, and also be able to, on a monthly basis, be able to manage your monthly payments or lifestyle? And there's effective tools out there, but you have to talk to somebody to get ahead of it, because 55 turns into 65 just like that, right? Yeah. And then you might be in a position where it's not that it's too late, but you actually could have had a lot of financial growth in 10 years just because you didn't move the needle on having a conversation. So I recommend anybody, and not even starting to that age group, like, realistically, even 35, just to start having that conversation of what to think about. A lot of people don't think about savings, right? And the problem is they don't think about savings, and then 10 years goes by and another 10 years goes by, and they're missing out on opportunity. And financial literacy has never been a priority in Canada for many reasons. Mm-hmm. And so what's happened is people have been so fallen short on savings and financial wealth because they don't know. And that's why I get so passionate about it, because I see so many people struggling later on in life, and you can't realistically move the needle on a lot of income. Yeah. So we have to look at ways of providing open conversation, discussion like this, to get people to call in, set times, and let's go through what you have so we can help build your wealth and have a comfortable, retirement.
And you talk about that idea of financial literacy. Is a lack of financial literacy probably what gets in most people's way of contacting you and saying, they don't know maybe they don't want to admit that I really don't know what's going on?
I think it's a couple of things. I think it's one is they don't know. But I also think that it's that they're scared because they feel either ashamed that they don't have it. They think they should have this number, but yet they don't know the number. They just think they should have more than what they have. Everybody feels guilty on their finances. I don't care what position they're in. There's just this overall sentiment it's Canadians. It's a lot about that. That we just haven't been able to save a lot. But yet some people are actually really good. They just don't know. So when we sit down and go, you know what? You actually do have some really good retirement here in what's in your home. But let's look at ways of being able to utilize this. And maybe it's utilizing it so that you can retire earlier. And it could be like I've had a lot of people come in that have had health reasons and can't work anymore to the extent they were doing. But they've got their home and equity rich. Well, let's look at ways to be able to make your life comfortable so that we can take care of you from a health perspective and maybe, prolong your life another, 10, 15 years. So it's just starting to have the conversation. I think that's the most important thing.
And always good for us to have those chats as well too, Tracy. Speaking of chats, what's on the horizon? What's going on with Valko Financial these days? What's coming up this week?
So we've been doing a series of webinars this year. It's been extremely good. So many people have been calling and joining them. It's a lot of education. We go from renewals to purchasing a house to debt consolidation to reverse mortgages. We're going to get into investing, and we're doing it all year, right, to help people and really move the needle. So the next one we have is next week on the 6th of August. It is called The Future of Purchasing, Trends, Risks, and Opportunities. So if you are looking to purchase or know someone, please make sure you look at on any of our social media. We'll have the link for you to be able to register. It's a free webinar. And it's just great information for an hour with some good tools, and then, availability to be able to book some time to speak with us so we can go through any questions you have.